Abneesh Roy is joining us, Executive Director at Edelweiss. Abneesh, good morning. Thanks for joining us. Let's start with ITC first. Always a good dividend yield play, right? Especially in the last 1 or 2 years. But looking at the numbers and the way the stocks moved, what's your call here?
So we remain quite positive on ITC. We have a 30% weightage on ITC in our model consumer portfolio. Numbers were really strong, which has already been discussed. So if you see from February 1st to now, ITC stock has done quite well. It has outperformed the indices, outperformed the consumer sector. We expect that trend to continue because of 3-4 reasons. One, of course, is legal industry will keep gaining market share in cigarettes in FY23. So if you see in Q4 also, cigarette volume growth of 9% on a base of 8%, I think we are not seeing this kind of a growth for many years in cigarette. That again shows when we have a rational tax policy, it is good for the government also, and we see good volume growth also coming back versus illegal. Second, of course, is mix also in cigarette is improving. As mobility is coming back and as price laddering is being used by ITC, we are seeing that the mix is improving. Second, of course, in FMCG, yes, the HPC and foods could see margin pressure in the near term because of high inflation, but stationery business is going to come back because schools have now started. Essentially, FY23 will be a good bounce back year for stationery business. And if you see in FMCG, now 7% of the sales is coming from e-commerce. I think that's a very good number. And ITC has been on the forefront in terms of investing into D2C startups and their own e-commerce portal, etc. And agri and paperboard again should be very strong here. Agri, yes, the wheat export ban is slightly negative in the near term, but ITC will have a lot of opportunity in terms of the tobacco exports, rice exports, soya exports also. And I think wheat exports, let's see whether it's a permanent ban or it's a near-term ban only. Paperboard, again, extremely strong volume. So net, I think the stock should touch our TP of 325 in the coming quarters. Because if you see, ITC offers the best predictability of earnings in the consumption space currently, when rest of the consumer stocks are seeing inflation. In ITC, cigarette business is the main business. There is no cost inflation, which is taxes. And second, of course, with global liquidity, drying up interest rates, because investors are looking for defensive ideas, and clearly with 4.5% dividend yield, that's a very good dividend yield we are getting in ITC. So we remain quite positive, 30% weightage in the consumer portfolio.
Okay, quite positive, 30% weightage in your consumer portfolio. It's also been the best Nifty performer this year, right? I mean, in 2022 alone, ITC has gone up, 21%. On a valuation parameter, trading at 18 times FY23, how does that look to you? And would you raise your earnings estimates or target price post these numbers?
Yes, so in terms of valuation, comfort again, 18-19 times, it is not expensive. And globally also, we have seen cigarette stocks have re-rated in the past few months. Again, going back to the thesis that global liquidity drying up, interest rate hikes coming. So we are seeing the defenses coming back into play. I think HUL stock also was discussed prior to this. That's also doing reasonably well in the last 2 months. Coming to numbers, yes, there will be slight upgrade based on these. But definitely what we see is there is some cost pressure in the FMCG, which we discussed in HPC and foods. So yes, I think 12-13% earnings growth in FY23. I think that's possible for ITC, which I think will be difficult for most other consumption stocks, especially in the first half. So yes, we do expect good earnings growth to continue in FY23 and possibly even in FY24. But for FY24, we need to watch out what happens on February 1st, which is still 2-3 quarters down the line.
Absolutely, that was actually my next question. And if you see, the market's clearly making that distinction, right, Abneesh, between lever and ITC. There's a massive underperformance for lever. How much of inflation pressure do you think the market still has to negotiate in terms of players like not just lever but Godrej as well going forward? How much more derating is possible?
So two things. One is in Q1 you will see the peak of gross margin pressure because there is a lag effect of 1 to 2 months before the commodity starts impacting. That's why Q4, if you see on the EBITDA margin front, FMCG companies are managed quite well. But yes, Q1 is going to be a bit more challenging, and that's why more price hikes have happened by HUL. So what we are seeing is definitely on the 30% LUP, there is an issue because you can't keep cutting price grammage there. So FMCG companies have come out with bridge packs. So essentially not at 5 rupee, 10 rupee, 12 rupee, 17 rupee, which is helping them partly. And in rest of the portfolio, 70% of the portfolio, I think good pricing power is still there. But yes, first half, especially Q1, there is going to be a margin pressure for the HPC and foods companies. ITC will be an outlier there because on the 85% of the business, tobacco, there is no inflation really. So we will continue to prefer ITC, 30% weightage we do have. But yes, pricing power in HUL and Britannia, you will continue to see. Britannia, we expect 10% kind of price hike to come even in FY23, over and above the 10% hike which happened in FY22. For HUL also, I think high single digit price hike is very likely in FY23.
All right, we leave it at that. Abneesh, thanks a lot for joining us. So that's on ITC and HUL and the entire FMCG pack. The market, by the way, is threatening to start